Guys, so investors are very concerned about what's happening in the Chinese market, and we're going to learn why that is in today's video. So, bond yields in China, which are a measure of the overall price that the government bonds are offering, the yields have declined on the Chinese bonds to the lowest level since 2008. For a measure of comparison, the differential between the yields in the US Treasury bonds versus the Chinese bonds is almost 3%, which is completely unlike the typical cycles where the US bonds and the Chinese bonds are usually yielding the same level. Now, this comes at a very weird time for China because globally, inflation is going up. If you look at the UK, if you look at the US, Europe, inflation rates are rising up again, and the governments there are not in a position to cut rates. This is also because if you look at hiring and business activity, especially in the US, has been expanding at a very rapid pace. But the situation is the opposite in China, which is what's gotten investors very concerned. And that's why there's been a huge sell off in the equities market. The yuan has also depreciated, and people are just being risk averse and holding on to their money. And what this basically means is that there is a huge concern that there is a Japanification of the Chinese market. And this is a reflection of what happened in Japan in the 1990s, where individuals and corporates just refused to invest. And what happened as a result was that the Japanese economy just did not expand and just remained stable and at a flat rate, deflation, not growing for 3 decades. And as a result of which, the stock markets lost nearly 70% of its value. The same concern is there in the Chinese market, and there is a point that are we in a position where individuals are not really spending money, corporates thereby are not investing money, and as a result, there would be a huge decline in economic activity. It remains to be seen. However, what I'll add here is that the story is maybe a bit excessively negatively sold in the Western press. Because essentially, if you look at the Chinese exports, the reason why inflation has been declining in the Chinese economy is because of two reasons: prices of automobiles and prices of fuel. And the fact that these things are declining in value is actually a good signal in the Chinese economy. And it's a signal that the Chinese manufacturers of automobiles are reinventing themselves. And they are, frankly, quite a bit more competitive versus the Western counterparts. So, personal opinion is that this is widely oversold. The Chinese economy will be able to tide over this period of relative softness, and it will be the growth engine of the global economy in the coming decade. I would like